Do you perceive that stillness? That profound quiet? It is the unmistakable sound of a marketplace holding its collective breath. At this very moment as I address you, the valuation of silver rests at $65.77. It is not in freefall, nor is it experiencing an explosive surge. It is simply suspended, poised, in a state of patient anticipation. To the casual observer, this equilibrium appears uneventful. They glance at their screens and might remark, well, nothing is happening. The excitement has dissipated. However, for the seasoned trader, this very silence is deafening. This is not a void of boredom. It is a palpable tension. It resembles two formidable armies positioned on opposing sides of a vast battlefield, locked in a stare-down, awaiting the descent of twilight. We are drawing near to the most pivotal juncture of the financial week, the weekly close. For the preceding 5 days, financial institutions have waged a concerted effort to destabilize this market. They deployed margin rate increases and unleashed a barrage of short-selling contracts. Their objective was to forcefully drive the price back down to $60, an endeavor that has thus far proven unsuccessful. Observe the current price, $65.77. We are maintaining a strategically advantageous position. The sheer tenacity of silver in resisting a decline stands as the most compelling bullish indicator I have witnessed in 4 decades. In this market analysis, we will elucidate the historical significance of this particular Friday closing price. We will examine the weekly candlestick formation and decipher why automated trading systems are programmed to initiate purchases should we sustain this price threshold. Furthermore, we will dissect the coiled pattern that is presently taking shape. The spring is fully wound, the tension is at its apex, and an imminent explosion is unavoidable. The major financial entities have expended their most potent offensive, and the market has merely shrugged it off. Let us delve into the specifics. Why do I continually emphasize the importance of Friday? What distinguishes a closing price of $65 from $64? Is it merely an arbitrary figure? The answer is unequivocally no. Within the realm of institutional finance, daily price fluctuations are often considered mere noise. Hedge funds do not concern themselves with mid-week market movements. Their focus is squarely on the weekly conclusion. The weekly close serves as the ultimate arbiter, declaring the victor of the week's market contest. Did the bulls prevail in driving the price upward, or did the bears succeed in pushing it lower? Over the past 3 years, on every occasion that silver attempted a significant upward movement, financial institutions historically exploited the final hours of Friday to engineer a sharp price decline. They would inundate the market with substantial volumes of derivative contracts immediately preceding the closing bell. Their motivation was to render the weekly candlestick appear unfavorable, characterized by a prolonged upper shadow. This visual cue signals weakness and serves to deter technical traders. However, consider today's situation. We are trading at $65.77, hovering near the week's highest points. If we conclude the week at this valuation, the resulting weekly candlestick will be a robust, solid green bar, a phenomenon known in Japanese candlestick terminology as a marubozu. This signifies that buyers maintained control from the opening to the closing price, with no upper or lower wicks. Such a formation sends a clear message to every trading algorithm on Wall Street, confirming the legitimacy of the breakout and indicating the exhaustion of selling pressure. Most crucially, it activates trend-following systems. These are automated programs that manage billions of dollars and operate under a straightforward directive. If an asset concludes the week above its resistance level, initiate a buy order at the opening of the following week. The established resistance level was $65, and we are presently trading above it. If we maintain this position for the ensuing hours, these automated systems will execute their predetermined buy orders on Monday morning. This is the very reason for the palpable anxiety emanating from the major financial institutions. They are acutely aware of the algorithm's constant surveillance and recognize that if they fail to suppress the price within the next few hours, they will be overwhelmed by a torrent of automated buying activity in the subsequent week. Therefore, the stillness you observe at $65.77 is not one of passivity, but rather the tranquil prelude to an algorithmic storm. Let us now examine the prevailing chart pattern. When a rocket ascends into the atmosphere, it eventually depletes its fuel and must decelerate. It requires refueling or risks a catastrophic descent. Markets operate on a similar principle. Silver experienced a rapid ascent from $60 to $66 in a virtually uninterrupted trajectory, a pace that is inherently unsustainable. Typically, following such a dramatic upward move, the price retraces to reassess its foundational support. However, silver has not receded. Instead, it has stabilized and entered a period of sideways consolidation, trading within a narrow range between $65.50 and $66. In technical analysis, this configuration is recognized as a bull flag. Envision a flagpole extending vertically upwards, representing the initial price surge. Now, picture a flag unfurling gently at the top of the pole, signifying the consolidation phase. This is considered an exceptionally healthy pattern, indicating that as some investors realize profits, new buyers are readily stepping in to absorb the supply. One might state, "I will sell at $66, and another responds, "I will buy at $65.80. This exchange occurs instantaneously, preventing any significant price decline. This phenomenon is termed absorption, where buyers seamlessly absorb sellers without allowing the price to drop. It is akin to attempting to submerge a beach ball underwater. The banks are exerting downward pressure, but the inherent buoyancy of the water, representing the buyers, pushes it upwards. At present, these opposing forces are in equilibrium, resulting in the stable price of $65.77. However, the banks are beginning to exhibit signs of fatigue, their efforts weakening. The moment they relinquish their hold, the beach ball will not merely float upwards, it will erupt from the water's surface. This bull flag formation signifies the market replenishing its energy, building the necessary foundation for a subsequent ascent towards $70. Consequently, do not be lulled into complacency by the stagnant price. Instead, embrace the excitement. It is often within these periods of apparent inactivity that significant gains are realized. There exists a distinct psychological dimension to this price level of $65. For an entire generation of investors, $65 represented an almost mythical target, a distant aspiration akin to reaching the moon. Many individuals declared, "If silver ever reaches $65, I will liquidate all my holdings." Today, we stand at that very juncture, with the price at $65.77, and to everyone's surprise, the anticipated mass sell-off has not materialized. While a select number of traders may have taken profits, the predicted exodus has failed to occur. Those who accumulate silver are holding their positions, as are investors in exchange-traded funds. The reason for this resilience lies in their dawning realization that $65 is not the ultimate peak. They observe the pervasive inflation, the escalating national debt, and recent developments concerning battery technology, such as news related to Samsung. This collective awareness leads them to understand that $65 is merely the nascent stage of a much larger trend. This represents a profound psychological victory. The banks had predicated their strategy on widespread retail selling. They anticipated that if the price reached $65, the general investing public would divest their silver holdings. However, these retail investors have not capitulated. Instead, they have demonstrated a newfound resolve, exhibiting a spirit of resilience previously unseen. We have come to appreciate the intrinsic value of our holdings and are now looking beyond $65 as an exit point, instead viewing it as a potential entry into a much larger opportunity towards $100. This shift in collective psychology is the very catalyst for a supercycle. When elevated prices do not suppress demand, but conversely stimulate further interest, it signals a parabolic ascent. I wish to draw your attention to what did not transpire today. It is Friday, a day historically associated with aggressive market manipulation. Typically, following the release of employment data, the dollar strengthens and silver experiences a sharp decline, a predictable sequence we have witnessed numerous times. We were prepared for such a scenario today, anticipating a potential drop to $64. However, this decline did not occur. The attempted suppression failed. The anticipated dog did not bark. The underlying reason is the extreme scarcity in the physical market. As we discussed in our previous analysis, precious metal dealers are experiencing depleted inventories, and refiners are operating at reduced capacity. If financial institutions attempt to forcibly drive the paper price down to $64, industrial buyers will simply step in and acquire more, viewing it as a favorable discount. Consequently, the banks have forfeited their capacity to manipulate prices downward. Their influence is now limited to merely stalling the market's advance or inducing sideways movement, but they can no longer orchestrate a price collapse. Each attempt to depress the price only exacerbates the physical shortage, thereby establishing a robust floor, a solid foundation at $65. We are currently navigating this established floor, and it feels exceptionally stable. Having established the market's inherent strength, and the critical importance of the weekly close, the pertinent question becomes, what lies ahead? What transpires when the clock strikes 5 o'clock and the market adjourns for the weekend? In the subsequent segment, we will explore the activation of automated trading systems. I will meticulously detail the operational mechanisms of trend-following algorithms and illustrate why a closing price above $65 will trigger billions of dollars in purchasing activity in the coming week. Additionally, we will address the inherent risks associated with holding positions over the weekend, explaining why retaining cash during this period is potentially perilous, while possessing precious metals offers a sanctuary of safety. The conflict is not yet concluded. Only a few hours remain, but the momentum has undeniably shifted. The major players are now on the defensive. Remain tuned for Part 2, where we will conduct an in-depth examination of the underlying mechanisms. If you are just joining us, allow me to provide a concise overview of the current situation. It is Friday afternoon, and the closing bell is rapidly approaching. The price of silver is steadfastly holding at $65.77. We have successfully navigated the morning's attempted price suppression and the subsequent profit-taking. We now stand at the precipice of achieving the highest weekly closing price recorded in decades. In our initial segment, we delved into the realm of human psychology, exploring sentiments of relief and vindication. However, in this continuation, we must now confront a starker, more dispassionate element, pure mathematics, and the influence of automated systems. In contemporary financial markets, a substantial 80% of trading volume is not driven by human intervention, but by algorithmic processes. These are managed by sophisticated black box systems, commonly referred to as commodity trading advisors, CTAs. These systems wield control over hundreds of billions of dollars, and at this precise moment, they are all fixated on a singular numerical threshold, $65. For the past month, these automated systems have adopted a cautious stance, awaiting definitive confirmation. However, should the closing bell ring in the coming hours with the price situated above $65, a fundamental alteration will occur within their programming. The decision-making logic will transition from a state of waiting to one of active execution. In this section, I will meticulously dissect the nature of this algorithmic trigger. I will illuminate why Monday morning could witness an unprecedented surge of automated buying, driven not by market news, but by the execution of intricate code. Furthermore, I will explain the inherent risks associated with the weekend period, demonstrating why holding on to cash over the ensuing 48 hours might represent the most perilous trading decision one could make. The human element has fulfilled its role, successfully defending the established price level. Now, the automated systems are poised to assume control. Let us peer into the operational core of a trading algorithm. These programs are designed as trend followers. They possess no inherent interest in factors such as solar panel production or national deficits. Their sole focus is on market momentum. From the perspective of a trend-following algorithm, any resistance level acts as a definitive stop sign. As long as silver traded below $65, this stop sign remained firmly in place, prompting the algorithm to maintain a passive stance and hold cash. However, when the price breaches a resistance level on a weekly time frame, that stop sign is superseded by a green light. This triggers what is known as a breakout strategy, based on a straightforward principle. If the price surpasses a defined ceiling, that ceiling is effectively dismantled. Billions of dollars in passive investment capital are intrinsically linked to this precise rule. If we conclude today's trading session at $65.77 over the course of the weekend, these investment funds will undertake a re-evaluation of their portfolios. They will meticulously calculate their optimal position sizing, and by Sunday evening or Monday morning, will execute market buy orders to fulfill their predetermined allocation targets. This phenomenon is the primary reason why Mondays following a confirmed breakout often exhibit such pronounced volatility. It signifies the arrival of substantial, coordinated buying power. The retail investor may have bought into anticipation of positive news, while industrial users may have acquired assets on perceived dips. Now the managed futures funds are entering the market to capitalize on the established trend. This wave of buying is relentless and indiscriminate. It is unconcerned with whether the price advances by 10 cents or $10. These funds have specific allocation objectives to meet and will continue purchasing until those targets are achieved. Therefore, if you are contemplating selling your holdings at this juncture, it is imperative to recognize that you would be selling directly into the path of automated systems that are on the verge of being activated. Now let us turn our attention to the impending 48-hour period, the weekend. Typically, traders harbor a distinct aversion to weekends, preferring to avoid holding open positions when the market is closed. They express apprehension regarding gap risk, the potential for unfavorable news to emerge and cause the market to open at a significantly lower price. However, within the context of a bull market, particularly one characterized by a currency crisis, this risk dynamic is inverted. The true risk lies not in holding silver, but in holding dollars. Consider the prevailing geopolitical landscape, the inherent instability within the banking system, and the persistent rumors of export restrictions that we have previously discussed. These global factors do not cease their influence simply because the New York Stock Exchange adjourns for the weekend. If significant news emerges on a Saturday, or if a major mining operation experiences a strike, or if a government releases unfavorable inflation figures, there is no immediate recourse to acquire physical silver. The market is effectively shut down. Investors will remain tethered to their fiat currency until the opening of trading on Sunday night. When the market does reopen, it is unlikely to resume from its previous closing price. Instead, it may gap upwards, potentially opening at $67 or even $68. In such a scenario, individuals holding cash would have effectively witnessed an erosion of their purchasing power overnight. They would be unable to re-enter the market at the prior price level. This very fear of missing out is what underpins the significance of the Friday closing price. Informed market participants recognize that the weekend represents a period of intense information flow. They would rather secure their positions in hard assets through this period of uncertainty than be caught holding paper currency that may have depreciated in value by Monday morning. This is precisely why we are not observing a significant sell-off today. No prudent investor wishes to be holding an undiversified cash position over the weekend. The prudent strategy has shifted. Holding silver is now the safer course of action, while holding dollars has become the riskier proposition. This represents a fundamental paradigm shift. Another salient indicator is manifesting itself through the media. For years, prominent financial news outlets such as Bloomberg, CNBC, and the Wall Street Journal largely ignored silver, or worse, they actively ridiculed it, referring to it disparagingly as a pet rock and labeling its proponents as irrational. However, observe the headlines emanating from these same sources this week. Silver outperforms gold. Solar demand squeezes supply. And is silver the new lithium? The prevailing narrative is undergoing a discernible pivot. Why is this shift in media coverage so significant? Because the media wields considerable influence over the collective behavior of the public. The average individual does not meticulously analyze charts or pore over mining reports. Instead, they are guided by what the prevailing media narrative suggests is trending. As mainstream media outlets begin to acknowledge and validate the supply constraints within the silver market, they effectively grant tacit permission for the average investor to enter the market. This reassures financial advisors that allocating client capital to silver is a prudent decision and signals to pension funds that silver is a legitimate and viable asset class. This influx of capital represents the wall of money we have discussed, distinct from the whales, or the sophisticated algorithms. The largest reservoir of investment capital resides with the general public, who are typically latecomers to emerging trends. However, their participation often amplifies market movement significantly. When the broader public enters the market in force, valuations can become irrational, unconcerned with specific price points like $65, but solely focused on the trajectory of upward price movement. We are currently witnessing the nascent stages of this widespread public awakening. Articles are being published, and television segments are being produced. In the coming week, the retail investor who may have disregarded silver for the past 5 years might contact you seeking guidance on how to acquire a silver coin. While this represents a lagging indicator of past price action, it simultaneously serves as a leading indicator of impending market exuberance. We are transitioning from a phase dominated by informed capital to one of broad public participation, a phase that historically culminates in parabolic price escalations. Finally, let us re-examine the options market. We previously discussed the concept of a gamma squeeze. Now let us consider the principle of max pain. Every Friday, option contracts reach their expiration date. The market makers, those facilitating these contracts, endeavor to guide the price to a level where the maximum number of options expire worthless. Typically, this involves manipulating the price towards a central point. However, today they have relinquished control. A substantial number of call options with a strike price of $65 have now moved into profitable territory. This signifies that the banks, obligated to fulfill these contracts, are now indebted to the option holders for that metal. They are compelled to deliver. If we conclude the trading day at $65.77, the banks will be forced to enter the weekend with a recognized deficit in their physical inventory. Crucially, they will have no mechanism to hedge this exposure during the market closure. They will be left to passively hope that no adverse news emerges. This scenario engenders considerable anxiety within their executive boardrooms. Consequently, on Monday morning, their immediate priority will be to cover their short positions, meaning they will be compelled to buy back the metal they were unable to hedge on Friday. Thus, the Friday closing price functions as a slingshot. The higher the price at which we conclude today, the greater the number of in-the-money call options, and consequently, the more significant the forced buying activity will be on Monday. This is a mathematical certainty. The derivatives market is now dictating the physical price, and currently, the derivatives market is issuing a resounding buy signal. Therefore, with the automated systems activated, weekend risks elevated, the media narrative shifting, and the banks ensnared, the logical question arises: where exactly are we headed? What are the projected targets? If $65 represents the floor, what is the ceiling? In Part 3, we will embark on a detailed examination of the technical roadmap. I will present the Fibonacci extension levels that precisely forecast potential pause points in this rally. We will scrutinize the $70 target and elucidate its significance as the next major battleground. Furthermore, I will explain the formation of the cup and handle pattern on the monthly chart, a pattern that has been developing for 45 years and suggests a trajectory towards price levels that may seem unimaginable today. Although the weekend approaches, the market charts never truly rest. Remain engaged for Part 3, where we will meticulously map out the path towards significant price appreciation. If you have followed me through Parts 1 and 2, you now possess a comprehensive understanding of the market's operational dynamics, the fundamental drivers, the inherent scarcity, the cautious behavior of financial institutions, and the pivotal role of automated trading systems. However, while fundamentals provide insight into what assets to acquire, technical analysis dictates the timing and direction of price movements. At this juncture, as we observe the price at $65.77, we are not merely looking at an arbitrary figure. We are witnessing the culmination of a geometric pattern that has been in gestation for 45 years. In this final segment, we will set aside news headlines, disregard pronouncements from the Federal Reserve, and overlook considerations related to mining operations. Our focus will be exclusively on the mathematical underpinnings of market behavior. I will unveil the cup and handle pattern, widely regarded as the most potent formation in technical analysis, and demonstrate why it points towards a target that may sound astonishing to the average investor, yet appears undeniably inevitable to a seasoned technician. I will guide you through the Fibonacci extension levels that delineate the path towards $72 and explain why, despite the current rally, the Relative Strength Index, RSI, suggests that silver is not overvalued, but rather is just embarking on its upward journey. The fundamental narrative serves as the engine driving this market, while the technical chart acts as the GPS, and this GPS indicates a considerable distance yet to be covered. Let us zoom out and transcend the superficial fluctuations of the 5-minute or even the daily charts. Instead, let us bring up the monthly chart, extending back to 1980. What becomes evident upon such a broad perspective? We observe a significant peak in 1980, reaching $50. This was followed by a protracted bear market spanning 3 decades, characterized by a long, rounded bottom formation. Subsequently, another peak emerged in 2011, also at $50. This series of events established a colossal cup formation, a bullish shape that required 3 decades to materialize. From 2011 to 2024, we observed the development of the handle, a period of gradual decline, consolidation, and the systematic elimination of weaker hands from the market. And now, at this precise moment, we are witnessing a breakout from this handle. This is the classical cup and handle pattern. In the discipline of technical analysis, the principle of the bigger the base, the higher in space is a fundamental tenet. A pattern that takes 45 years to construct does not resolve with a mere $2 price increment. Instead, it predicts a measured, proportional move. To calculate the potential target, we measure the depth of the cup from its lowest point around $4 in 2001 to its rim at $50, a range of $46. We then add this calculated range to the breakout point. $50 plus $46 equals $96. This is the technically derived target for this formation, $96 per ounce. This is not a speculative prediction fueled by hype. It is a direct extrapolation based on established market behavior patterns. We are currently priced at $65, representing merely 1/3 of the way through this projected measured move. This indicates that we are in the nascent stages of this cycle, not approaching its conclusion. The breakout above $50 served as the starting signal. All subsequent price movements, including the advance to $60, the subsequent consolidation, and the current push towards $65, are merely the market confirming the activation of this long-term pattern. Now let us refine our focus. We will examine intermediate price targets by employing a tool known as Fibonacci extensions. These are mathematical ratios observed throughout nature, from the spiral patterns of galaxies to the delicate structure of seashells, and even within human psychology. Markets exhibit a tendency to move in accordance with these proportional relationships. The most significant of these ratios is approximately 1.618, commonly referred to as the golden ratio. If we measure the price movement from the low point of $20 to the breakout level of $30 and project this range upward, the golden ratio extension converges at approximately $72. This explains why $65 currently functions as a mere waypoint, a strategic rest stop. The automated systems we discussed in Part 2 are specifically programmed to target these Fibonacci retracement and extension levels. They initiate purchases following a breakout and establish take-profit orders at subsequent extension points. Consequently, the projected trajectory appears as follows. We are currently consolidating within the $65 zone. Once we successfully establish this level as support, which is actively occurring at this moment, the gravitational pull of the market will shift towards $72. The price range between $65 and $72 exhibits minimal historical price memory, meaning the asset has not spent substantial time trading within this band. This translates to low friction, allowing for a potentially more rapid ascent from $65 to $72 compared to the pace observed between $20 and $30. The atmospheric conditions are less dense at these higher altitudes, facilitating more significant price movements. Therefore, if you observe silver experiencing a surge to $68, $69, or $70 next week, do not be taken by surprise. This will simply represent the market filling the price vacuum up to the golden ratio target. Now, I must caution you against a common pitfall. Inexperienced traders often rely on indicators such as the Relative Strength Index, RSI, which measures market momentum. When the RSI exceeds 70, it is conventionally interpreted as an indication of an overbought condition, and textbook advice dictates selling at such points. Currently, on the daily chart, silver's RSI is elevated, signaling an overbought condition, leading some novice traders to liquidate their positions under the assumption that a market crash is imminent. However, here lies the critical insight. Within a robust, trending bull market, an overbought RSI is paradoxically a sign of strength. An asset can remain in an overbought state for extended periods, even months. Consider the trajectory of Bitcoin in 2017 or Nvidia's performance in 2024 as illustrative examples. The assets surged past the overextended threshold, then doubled their value, and subsequently doubled again. The reason? An overwhelming influx of buying interest has pushed the momentum indicator to its absolute limit. Instead of signaling a potential downturn, this extreme reading now indicates accelerating price movement. To divest your silver holdings solely based on a high relative strength index, RSI, is akin to entering a high-stakes confrontation armed with inadequate resources. You are essentially opposing an unstoppable force, relying solely on a speedometer that indicates high velocity. While the speed is indeed significant, that is precisely the point. The weekly RSI, a far more impactful metric, remains considerably below its historical peaks. In the year 1980, the weekly RSI reached 95. In 2011, it peaked at 90. Currently, we are observing readings in the 70s. There is substantial room for growth before the market enters a state of widespread exuberance. Do not permit the overbought classification to deter you from participating in a once-in-a-generation trend. Markets can sustain irrational valuations for extended periods, often longer than an individual's financial capacity to short them. One final technical consideration warrants attention: round numbers. Psychological biases favor values ending in 0 and 5. We are drawn to 65 and 70, and we gravitate towards 100. These figures exert a magnetic pull on prices. As a price approaches these levels, it tends to be drawn in. We have just surpassed the $65 mark. The subsequent magnet is $70. The rationale behind 70: It represents a significant psychological threshold, evoking a sense of elevated cost. Sellers will predictably emerge at this point. I myself would consider selling at 70. However, in a situation characterized by scarcity, these round numbers transform into refueling stations. The price reaches 70, and sellers unload their positions. Yet buyers, such as major corporations like Samsung and Microsoft, along with entities like China, absorb all the offered supply. The price stabilizes temporarily. Subsequently, once seller exhaustion sets in, the price surges through the round number. We witnessed this phenomenon at $30, again at $50, and most recently at $65. It is anticipated at $70. Resist the temptation to game these levels, such as attempting to sell at $69.99 with the expectation of repurchasing at $68. You risk selling only to observe the price jump to $72 while you are asleep. During a squeeze, attempting to actively trade around the core position is a surefire way to relinquish your holdings. The prevailing trend is upward. The psychological magnets lie ahead. The force of gravity appears to be functioning in reverse. Consequently, the charting indicators are unequivocally bullish. Fibonacci projections suggest higher price targets. The cup and handle pattern remains active. However, charts alone do not guarantee financial gains. Profitable execution is paramount. How will you navigate the upcoming 48 hours? How will you manage the psychological pressures of holding a profitable position over the weekend? In the concluding segment of this series, Part 4, we will refocus on strategic implementation. I will present you with a defined weekend protocol. I will elucidate the rationale behind disconnecting from your electronic devices. And I will offer a final perspective on why inaction represents the most challenging, yet potentially most rewarding endeavor in the current market environment. The closing bell is imminent. The week's battles have been won, but the larger campaign continues. Stay tuned for Part 4. We are bringing this to a triumphant close. The trading week has concluded. The closing bell is sounding in New York. Trading algorithms are powering down. Financial professionals are departing for their weekend retreats, and the price of silver stands firm at $65.77. Take a moment to pause and inhale. Do you comprehend the significance of these recent developments? The financial institutions deployed every conceivable tactic to suppress this market. They attempted a significant price decline on Friday morning. Their efforts were unsuccessful. They sought to initiate a sell-off during lunchtime. These attempts also failed. The market absorbed every onslaught and maintained its upward trajectory. This week will be etched in financial history. We decisively breached the $65 resistance level. The gamma squeeze was triggered. Short sellers were compelled to cover their positions. However, we now enter the period most perilous for any investor, the weekend. For the ensuing 48 hours, the financial markets will be dormant. You will be unable to execute trades. You are left to confront your own thoughts, alongside prevailing news narratives. This is precisely when errors are most frequently committed. In this final installment, Part 4, I will furnish you with a comprehensive weekend protocol. I will impart the most challenging skill in finance, the mastery of doing nothing. I will explain why excessive contemplation over the weekend is the most expeditious route to jeopardizing your position by Monday. The conflict for the week has been resolved. Now the challenge is to secure the ensuing peace. Let us bring this home. There is a renowned anecdote concerning a trader named Jesse Livermore, celebrated as the foremost trader of the 1920s. He amassed considerable wealth during the great market crash. One day, a novice trader inquired, "How did you accumulate such substantial profits? Did you actively trade breakouts? Did you engage in short selling during price declines?" Livermore responded, "It was never my analytical prowess that generated my significant gains. It was consistently my ability to remain passive." The concept of passive observation, or sitting, sounds deceptively simple, yet it is arguably the most arduous undertaking. Currently, you are either holding a substantial unrealized profit or a significant investment position. Your instinct is likely to act. It desires to secure the gains, to mitigate perceived risks, or to make incremental adjustments. This weekend, you will undoubtedly encounter various news reports, perhaps concerning geopolitical tensions or alarming articles about interest rate policy. Your mind might suggest, perhaps I should sell half my position on Monday morning to ensure safety. Maybe I should purchase a put option. This internal dialogue is your adversary. In the context of a super cycle, which is the prevailing market condition, substantial wealth is generated by identifying a dominant trend and maintaining a resolute stance until that trend demonstrably reverses. Has the trend reversed? No. We just concluded the week at an intraday high. Has the supply shortage abated? No. Refinery operations remain suspended, so what compelling reason exists for taking action? The Livermore Principle dictates that if a trade is performing favorably, refrain from interfering. Do not prune a blossoming tree over the weekend. Your primary objective is to suppress the impulse to appear overly astute. Overconfidence can be detrimental. Patience, conversely, leads to prosperity. It is crucial to understand the dynamics of the media cycle. Financial news outlets require audience engagement throughout the weekend. However, with the markets closed, there is no price action to report. Their strategy? They manufacture urgency. They will invariably find a guest to assert that silver is in a speculative bubble. They will present an analyst who claims the $65 level represents a double-top formation. They will craft narratives designed to keep you fixated on the screen. You must disregard this weekend media cacophony. Remember, the individuals appearing on television do not possess physical silver. They receive salaries and compensation in fiat currency for reading from a teleprompter. They lack an understanding of the implications of Samsung's battery technology. They are unaware of the impact of China's export restrictions. Allowing this external noise to infiltrate your thinking over the weekend will result in waking up on Monday morning with a sense of unease. You will observe the pre-market activity at 4 in the morning, actively searching for a justification to sell. The instant a minor dip occurs, you will execute a sell order. Subsequently, a mere 2 hours later, the price will surge to $70, leaving you behind. This is how your position is subtly undermined. They leverage the weekend to sow seeds of doubt. Your defense is straightforward. Disconnect. Avoid checking news feeds. Refrain from visiting online forums. Engage in outdoor activities. Spend quality time with your family. The price will still be present on Monday. Staring at it on Saturday will not alter its trajectory. However, we must prepare for Sunday evening. Given the strength of this week's closing price, specifically the retention of $65.77, there is a high probability of a price gap upwards upon the opening of Asian markets. These markets will observe the week's closing candle. They will recognize that the Western financial institutions were unsuccessful in driving down the price. This suggests a weakening of Western market influence, potentially leading to an assertive move from the East. We could witness silver opening at $66.50 or even $67 on Sunday night. Should this occur, avoid chasing the price with leveraged positions. Gaps are frequently retraced. The price may experience an initial surge, followed by a pullback to $66 for a test of the support level. If you are contemplating increasing your holdings, do not purchase during the initial upward spike on Sunday night. This constitutes an impulsive buy. Wait for the price to retest previous levels and for the market to stabilize. However, if you are already invested, simply appreciate the situation. A gap up signifies that supply is so constrained that prices must instantaneously rise to discover willing sellers. Conversely, if adverse news emerges and the price gaps down to $64, do not succumb to panic selling. Recall the concept of a bear trap. A downward gap on Sunday is frequently reversed and bought up by midday Monday. Adhere strictly to your established plan. Remain aligned with the prevailing trend. I wish to conclude with a reflection on conviction. For many years, silver investors relied on optimism. We hoped that market manipulation would cease. We hoped that industrial demand would materialize. We hoped that the dollar's value would decline. This week, that hope has been superseded by certainty. We no longer need to hope. We observed the failure of major institutions to depress the price. The confirmation of Samsung's battery technology was announced. The formidable $65 resistance level was overcome. We are no longer engaged in speculative theorizing. We are actively participating in the creation of a tangible reality. The supply deficit is real. The scarcity is real. The price action is unequivocally real. This paradigm shift in perspective is critically important. When operating from a position of hope, one is easily intimidated. When operating from a foundation of certainty, one becomes unshakable. You possess holdings in what is arguably the most undervalued asset in financial history, at precisely the moment it is undergoing a revaluation by a world in dire need. You do not require hope, you simply need to exercise patience. Therefore, the verdict for the week is as follows. The bullish sentiment has prevailed. The victory was not easily achieved. It was a fierce contest, but we closed above the critical threshold. Technical indicators suggest a move towards $72. Fundamental analysis points towards $100. The market psychology is transitioning from fear to a fear of missing out. Next week, the contest will likely intensify around the $70 level. It will undoubtedly be a period of volatility and potential apprehension. However, you are adequately prepared. You possess the roadmap. You are equipped with the necessary defenses. Savor your weekend. It has been thoroughly earned. The closing bell has sounded, and for the first time in 45 years, it resonates with the unmistakable tone of victory. Subscribe.